traders and investors. This is Ken Goldberg with this morning's pre-opening comments, Monday, September 21st. As always, starting with the stock index futures, upper right-hand corner of the chart, you're looking at the Dow futures showing overnight gains and pre-market stability at plus 73 after Friday's sharp decline from the late Thursday FOMC meeting whiff at bat, as what we're calling it. Stepped up to the plate, swung, missed. They should have cut. They didn't. The market got mad, as we predicted, and the markets fell sharply. You can see in that upper right-hand corner, the daily stochastics have now crossed down sharply, giving a separate independent sell signal, along with the sell signal that comes from the corrective pattern from this low here in late August, chop, chop, chop overlap to this peak Thursday afternoon. Let's move real quickly from the blue chips. Here's the same chart. I'm going to drag it over a little bit from the E-mini S&P. And we now have the line in the sand in the S&P futures is now 2012, 2010. That's moved down from the former line in the sand before the Thursday reversal was 2033. That came off this low back here in early July. But now the line in the sand for the bears to maintain control of the market, which they now have, 2012 on the E-mini futures. Rolling right into the NASDAQ mini futures. Their line in the sand is about the same area as it was before, 44.33, let's call it, 44.35, give or take a few. But you can see daily stochastics cross down, hard down now again. Finally, the Russell cross down stochastics, reversal off the same point, and headed south. Now, the decline in the markets since Thursday's peak, as you can see here, I'm going to blow it up. This is a 122-minute chart. This decline I'm showing you right here is sharp enough to consider the initial decline complete, and this bounce that's happening right now is all or part of a corrective move that's either going to head south at the open today or have one more down, up sequence to complete before heading south into the open. Either way, bigger picture, other than the next few hours, the bigger picture is for a decline in all indices below this low here, far left lower corner, below this low in the yellow box from the August 24th low. Let's step into the interest rate futures. These are the bond futures. We'll look at the yields in a minute. Bond futures, we were looking for a bounce. I'm still in the upper right-hand corner chart, the daily bar chart. We're looking for a bounce in the last week. It started, so either all of the bounces complete or the first up of an up-down-up sequence that takes us closer to 158 is in play. Daily stochastics have room to rise, so we're going to give it the benefit of the doubt. What's that look like on a yield chart? Here's the 30-year yield. As you can see, the stochastics have room to fall, as does the wave count, if this wave C of 2 is not yet complete. It looks like there's a little bit more action coming, probably closer to the 2.86% yield, currently trading at 2.97. So a little bit lower yield. That would account for a little bit more rally in the bonds that we just showed. And then yields should turn higher, bonds should turn lower. Energy complex, here comes crude. Had more consolidation last week after middle of the week, early in the week, popped higher. Here is our path. Here is the DSE's path. Either wave 2 is fully complete as of last September 10th, or this sideways action has another up or down wiggle to come before wave 3 takes crude prices into the upper 50s, followed by a high-level consolidation back to the mid-50s, and then the final move in the first 5-wave sequence off the bottom up towards the low to mid-60s, 63-ish. But for now, in the pre-open, is actually the regular open for the crude market. Crude's up $1.32, and that is within 10 cents of its high for the day. Crude. Moving into the metals complex, last week saw a nice turn up in gold, having completed likely the wave 2 decline. So like crude's strong up and then sideways, gold had the same strong up off its low, then sideways, and last week started its next move pretty sharply higher last week and the last few days of the week. That market looks a little soft on the open, but that shouldn't last very long. 1125 should hold gold futures in the next few hours, and then at least a test of 1150 should come before any significant, and it's not even significant. Actually, here's what that looks like. What we should get is a move up to 1150 in gold, a retest of 1120, and then a much higher move up towards 1300. So any pullback in the next few hours to a couple days here is just consolidating this initial move, strongly higher in gold. Silver looks the same, not quite as clear. We'll skip it for today. Instead, we'll look at the copper. This right here. This actually looks much more similar to gold than silver. Copper as well. Upper left-hand corner now, the monthly bar, deeply oversold monthly stochastics. Weekly crossed up strongly. Daily as well, got a little overbought. Copper a little bit of trouble in the 249, 250 area, consolidating, higher copper prices to come. Lastly, we'll take a look at the currencies. Euro had a big turn down last week after DSE projected that this rise was corrective. I'm in the upper right-hand corner chart again. This rise is corrective. I'm going to blow up the weekly chart because that is really the best way to see, as well as the monthly chart, the best way to see the pattern. This big decline down from the May high at 1.40 all the way down to 1.05. 40 to 05, that's a monster move. But the bounce off that monster move is corrective. Up, down, up, A, B, C, telling us that that low of 1.05 is at risk of breaking with a very high confidence, and the bears are in control. That look like on the inverse, the dollar chart. Here we are. High-level consolidation after a monster dollar rally. Switch this over to the monthly chart. This pink box is the target for the coming final move in the dollar off of the 2008 low. Here's that low. Big consolidation. This final move into the pink box will create a lower high than the 2001 low, and this will be when all dollar assets need to be exited, because from this red box, the dollar should be cut in half in the next 3 to 5 years. If you don't think that can happen, look what happened between 2001 and 2008. In 7 years, the dollar fell from 122 all the way down to 70. That was about a 40% move. The next one should be at least as aggressive, if not more so. So the DSE is projecting a 50% decline in the dollar from this red box. That wraps it up to this morning. This is Ken Goldberg. Have a great day.